Karthik Kumar and find out what he's making of the markets right now. Karthik, hi, morning. Great to have you on ET now. Karthik, just wondering what's leading to this unease in the market. Is it just lightening of positions ahead of earnings, or is there something more to it?
Good morning. Thanks for having me on the show. I think it seems like at the outset, it just seems like a continuation of what we saw last year, where FIs continue to sell, DIs continue to hold the fort. But I think what we are seeing in terms of US policy or the trade agreement, delay in the agreement and the noises coming from there, I think that has also contributed to the volatility that we've seen since the beginning of the year. But notwithstanding that volatility, I think the focus essentially shifts to the earnings season. Especially what we've seen is progressively over the last 3 quarters, we've seen the earnings cuts or expected earning cuts kind of decreasing progressively through the last 3 quarters. And this quarter, going into the earnings season, the earnings revisions have been flat to slightly positive depending on the universe that you're tracking. So I think that is positive to start with. What we will look forward to, or what we will kind of focus on, is not just the earnings but also the commentary to kind of get a confirmation that the positivity that we saw post GST cuts is something that will continue over the next couple of quarters as well, and it was not just a knee-jerk kind of reaction post the cuts. That's what we will all be looking forward to.
Right. Karthik, morning. So how do you map this with the way markets have moved and how valuations currently look? Because we'll be penciling in FY28 very, very shortly in terms of the earnings and the growth. So how should one look at how markets have moved? Have we moved ahead of what the growth could well come in, or are we behind the curve?
So if we take valuations as a kind of a way to kind of assess that, valuations are a bit more normalized now, and when you move to FY28, that will look even better. So from that perspective, we've certainly not moved ahead. And what we've seen last year is essentially, if I look at it from purely quantitative perspective, what we've seen is that last year the kind of stocks did well were largely value stocks or stocks with low volatility. And given that this year I expect growth signals to kind of stabilize, growth revisions to stabilize, earnings both projected for FY27 and 28 being broad-based to kind of hold largely, I think the focus comes back to growth, or should come back to growth and growth revisions along coupled with quality. I think those stocks or those styles should kind of make a comeback compared to what we saw last year.
Right. Okay. That's the take coming in right now in the market. So I think, Karthik, in this, or rather in the previous year, the fact that multi-asset allocation really worked wonders. One is wondering what should be the strategy going forward too. Concentrated equity exposure, or do you think it makes sense to have, other asset classes as well in one's portfolio?
I think the answer always has been that we should have diversification and hence allocation to other assets classes as well. That's our house view, and we are still constructive on let's say something like a gold or a silver. But having said that, we've been ourselves surprised by the rally and the strength of the rally in there. So which is why we would kind of advocate for more asset allocation and across different categories.
Okay. Stick to asset allocation. Karthik, in terms of the earnings bias, where will it lie, and how best do you play the earnings growth that will follow likely post all of the policy measures that have already taken place in 2025? How do you play that?
Now, when we look at earnings expectations, they are expected to be strong in areas like autos, OMCs, cap goods, and telecom, whereas it's likely to be weaker on IT, pharma, and some of the consumer names in the discretionary non-auto space is likely to be a bit weaker. So that's how the layout of the land looks so far, and I think we'll wait for the company results and the commentary to kind of take it forward from there.
Okay. Karthik, I understand you have a positive bias towards private sector banks, at least in your fund at this point. Talk to us about the thesis that you're likely seeing will play out, because it's not a space which has drastically outperformed over the last year. So in your sense, what's gone wrong and what lies ahead, in your opinion, with regard to that pack?
So actually, we are just to kind of take a step back. We are bullish financials largely, and within financials, selective private banks, PSUs, and also NBFCs. So it's a good kind of mix within the financial space. But specifically with regards to banks, I think last year was all about policy easing, and this year, as the impact of rate cuts kind of come in, liquidity, the increased liquidity, that also kind of starts to hit the markets. I think what we will see is an increase in credit growth. And kind of margin stabilizing from here, and that is what is driving our preference for financials.
Interesting. Karthik, curious to know, what are the other key heavyweights or overweights right now, whatever you're recommending in terms of sectoral exposure?
So we continue to remain overweight autos, both two-wheelers and four-wheelers. Continue to remain bullish telecom and some T&D names as well. Remain light on IT, not as much, but still slightly remain underweight IT. And then utilities, and as I said, consumer discretionary, non-auto consumer discretionary also is where we are slightly light, at least on the quantitative side.
Karthik, what are you seeing in IT? Because it's one of the top contra players at this point. Valuations have come off, and versus the index as well, valuations are lower. And trying to get a sense as to where you stack up in terms of IT. A top line surprise could well lead to a re-rating as well. So I'm trying to get a sense as to how you're seeing it.
So I agree that the valuations are moderated and was on an absolute basis, on a market relative basis, which is why I said while I'm underweight IT, not as much. Completely agree with you on the valuation side. Where it'll be where we need confirmation data points is essentially the earnings season this year, and also in terms of guidance, because if you look at the numbers and upgrades to earnings within the IT space, across the cap space, be it large, mid, or small, where what we need to see is an improvement in earnings expectations, and that will kind of tilt the scales more in favor of IT as we go through the earnings season.
And Karthik, hospitality, you've got a large private equity fund coming in and buying stake in one of the marquee names within the hospitality space. How do you view that pack, and how do you view valuations evolving? Because we've seen an overshoot to some extent, especially in the leader within that pack, and then we've seen a sharp withdrawal. So I'm trying to get a sense as to where we're placed in terms of the cycle.
So, from a quant perspective, from a purely quantitative perspective, I have very little exposure to hospitality. Kind of trim this over time. So, I'm kind of a bit light on hospitality right now, especially going into the earnings season. I'll want to watch the trends there. But there are, there are funds that in-house that where we are specifically looking at those areas, and the view there could be slightly different. But this is purely from a quant perspective.
Karthik, I think it's also important to analyze where is it that you're seeing meaningful, earnings upgrades coming in. While, of course, the last quarter turned out to be pretty much at par with market expectations, any surprises or positive takeaways that you're expecting from this earnings, which kickstarts today?
So earnings upgrades, where we are seeing that right now is we are seeing earnings upgrades in autos, we are seeing earnings upgrades in industrials. And those are a couple of sectors where we are seeing earnings upgrades, and also OMCs. That's another area where we are seeing earnings upgrades. And the other areas where we touched on a couple of sectors where we are yet to see, and if those kind of join the party as well, then that's something those sectors would be sort of worth looking into.
Okay, Karthik, if one were to ask you with regard to realty where you stand, because again we've had a couple of numbers which were a bit disappointing, which came over the weekend. Concerned with regard to the realty cycle, maybe turning a corner?
I don't think realty sector is turning the corner, or there's something concerning there. But just in terms of opportunities, in terms of sector positioning and playing the cycle, I think there are probably opportunities elsewhere, and that is purely coming from a positioning perspective and playing the cycle perspective rather than taking a call on reality. Personally, I don't think that we have necessarily anything to be worried about the reality sector. Aside from the normal cycles, nothing. I don't think there's anything to worry there.
Right. And Karthik, have to try and analyze what the budget could actually entail this time around for markets, and whether there could be anything meaningful to really impact market sentiment.
I think the government's done its fair bit ahead of budgets this year, both in terms of be it the monetary policy or with regards to GST cuts. So I think we have to look forward to the budgets and see what is in it. But I don't expect something groundbreaking in that sense from the budget, because a lot of it they've already done beforehand. So I think it'll be more of tuning rather than large changes.
Okay, thank you so much for that, Karthik. We'll let it, we'll leave the conversation at that, but thanks so much for joining us this morning and giving us that perspective. Shweta Rajani,